Large US organizations once kept routine processing costs variable by routing high volumes of standardized work to offshore labor providers. Transaction reconciliation, initial document review, and routine analytical screening could be expanded or reduced through vendor contracts rather than carried fully inside the domestic cost base. That flexibility allowed expenses to move with transaction volumes without requiring permanent domestic headcount or infrastructure commitments. That model is now being re-examined. Finance and operations teams are modeling whether AI systems can absorb portions of the same work internally. The apparent advantage is straightforward: reduce external service spend, tighten process control, and improve operating margins. But the substitution does not simply move the work from offshore labor to software. It changes the behavior of the cost base. Lower wage arbitrage is exchanged for higher process control, but higher control arrives with greater cost rigidity. To see the change clearly, consider a simple cost stack. On the left, one large variable offshore labor block. On the right, that block shrinks, but three new blocks appear: committed infrastructure, legacy integration, and domestic exception oversight. The cost base changes shape, not merely size. The system lowers the most visible labor block, but it replaces that block with capacity, integration, and oversight costs that do not flex the same way. The savings are visible, but the cost base becomes harder to adjust. Under this recomposition, automation reverses geographic labor arbitrage by reducing reliance on lower-wage external providers. It converts a cost that's scaled with transaction volume into commitments tied to capacity reservation, data synchronization, and domestic oversight. This is the central margin risk. The old model bought flexibility through wage geography. The new model buys control through automation capacity, but capacity must be utilized, integration maintained, and oversight contained. The economics improve only if the internal cost build remains smaller than the external labor reduction. The first clarification is exception handling. Automation rarely covers every case on initial deployment. The remaining cases concentrate complexity, ambiguity, or control sensitivity. In US operating environments, those cases still require timely resolution to protect service levels, auditability, and internal controls. The review layer therefore reflects domestic labor economics rather than the arbitraged rates previously applied. Labor savings arrive first in the easiest cases, while remaining review cost concentrates in the harder tail. Where exception rates remain material or decline slowly, the net labor reduction narrows. The margin contribution is sensitive less to the headline automation rate than to the exception profile encountered at production volume. A second clarification concerns legacy integration. Most established US organizations run core processes on environments that have accumulated customizations, data structures, and interdependencies over many years. Linking automated workflows into those environments requires data mapping, exception routing logic, monitoring interfaces, and ongoing synchronization. These costs do not replace existing maintenance burdens. They layer on top of them. Integration therefore behaves less like a transition expense and more like a persistent addition to the cost base whenever legacy complexity is material. It also creates allocation distortion. Labor savings may appear in a business unit P and L, while integration spend lands in central IT, shared services, or operations budgets. The margin improvement can look cleaner locally than it is economically. Early pilots often show clearer unit cost improvement than scaled deployments. Pilot environments can be isolated from legacy drag, demand variability, and cross-budget allocation problems. In production, the automated layer must coexist with the operating system already in place. The cost reduction remains real, but it becomes surrounded by costs that are easier to undercount during approval than to unwind after deployment. In practice, finance and operations teams track two movements at once: external labor spend falling and internal infrastructure, integration, and oversight costs rising. The margin case holds only while the internal cost build remains visibly contained. They also test whether realized savings reach reported margins or are absorbed by competitive responses, internal reallocations, or quarterly targets that reward visible vendor spend reduction before the full cost trajectory is clear. The reported margin benefit can therefore lag behind the operational improvement. A further boundary appears when demand fluctuates. Offshore labor capacity could be contracted or expanded through vendor agreements. Automated capacity behaves differently. Reservation costs, depreciation, and platform obligations continue even when short-term volume falls. Oversight labor can flex, but only within domestic labor market constraints and the time required to retain or reassign trained personnel. Under stable or rising volume, the automated model can improve margins because fixed and semi-fixed commitments are spread across more work. Under contracting volume, those same commitments become more visible against revenue. The reversal is strongest when throughput remains high and predictable. The case deteriorates when throughput declines, exceptions remain labor-intensive, or integration spend absorbs savings before they reach reported margin. Returning to the cost stack, the right-hand side shows the offshore labor block materially smaller. But infrastructure, integration, and domestic oversight have changed the economic character of the system. The new model reduces dependence on external providers while internalizing more of the burden required to keep the work moving. The advantage persists where infrastructure utilization remains high, legacy integration remains contained, and exception-driven oversight does not rebuild labor cost in a more expensive domestic form. The organization may gain more control over execution without gaining a durable margin advantage. Margin expansion from labor arbitrage reversal registers only when the new cost regime remains smaller, steadier, and more controllable than the labor model it replaces. This is where automation turns geographic labor arbitrage into durable margin improvement, and where it becomes only another form of cost rigidity.